Have you ever found yourself completely lost reading a company's financial statements? I know I often do. The world of financial accounting is a vast and complicated area of specialization that may seem confusing to the casual observer. It requires careful observation and a willingness to pay close attention to detail. And although this concentration may seem a bit overly formalized and quite dull, I can assure you that it is a very complicated or a very important profession and area of study. As an accounting major, I can help you gain a basic understanding of these documents that drive the world of financial accounting. I can assure you that with my explanation of these three major financial statements that are used to show a company's financial position, you'll have a much better understanding of what these statements are, how to read them, and what they mean in today's business world. I will discuss the statement of income, the balance sheet, and the statement of cash flows. The first major financial statement is the statement of income. This financial statement gives the reader an idea of how the company operates and how efficiently it does so. This statement begins by showing the company's total revenue subtracted by the cost of goods sold to get the company's gross income. The next lines show the operating expenses for the company, which include things like wages paid, utilities, rent, and other expenses resulting from the company being in business. These operating expenses, plus taxes and many interest charges that the company incurred during the year, are subtracted from the gross income to get the company's net income, or their bottom line. Basically, on the income statement, you want to see low operating expenses and a high net income, as explained in Clausen's Journal of Accounting and Reporting in the article titled Net Income and What It Means. The second major financial statement is the balance sheet. This statement is used to show a company's assets in comparison with the liability and the equity the company has. The asset side includes things like cash on hand, stocks and bonds, mutual funds the company may have invested in, equipment and land the company owns. The liabilities and equity side shows things like loans, accounts payable, and stock issued by the company to operate its business. The reason the statement is called the balance sheet is because the dollar amount of the assets must match up with the dollar amount on the liability and equity side to show investors that the company has enough assets to cover its liabilities and equity, so that if it needs to come and pay a loan or an account payable fast, there is money or an asset that can be liquidated to pay that debt, as reported in Spiceland's textbook of Intermediate Accounting and Reporting in 2009. The final major financial statement, and arguably the most important, is the statement of cash flow. This is by far the most informative and yet complicated financial statement out of the three. This statement shows how cash flows through the company and what a company is spending their money on. It is broken down into three sections. The operating section, which shows increases and decreases in short-term assets and liabilities. Investing activities, which shows what long-term assets like trucks, operations, facilities, and land were sold off or bought during the year. And financing, the financing section, which shows if loans were taken out to finance this year's operations, if bonds were issued or stock was issued, or how it was paid for. Basically, this statement tells you what the company is doing with its money, what it's investing in, and how they're doing it. In today's world where, unfortunately, we've seen some unethical behavior and fraud in the accounting profession, this statement has really helped curb some of that by telling investors and showing them what a company really is doing, as opposed to what they're trying to tell you they're doing. It is still a relatively young financial statement compared to the other two, only coming around 20 years ago, according to the principles of accounting.com, but it is slowly becoming the most popular of the three and the most telltale of the three. The income statement, balance sheet, and statement of cash flows are all essential to today's business world and are important to understanding a company's financial health and what is really going on within the walls of a company. You will now have a better understanding of what these statements are and how to read them and how they are produced in financial accounting. Now, In the future, if your boss or coworker asks you to explain what is going on financially at your company through the use of these documents, you will have no problem doing so.